Good morning, everybody. Good afternoon to my friends on the East Coast. Well, we got ourselves a move today, didn't we? We got ourselves a move. Here's the good news. This move worked very well to our benefit, didn't it? And yeah, absolutely worked to our benefit. Let's talk about what happened with our gap trade, okay? And you guys can show my screen. So it all starts, you guys are thanking me. I'm thanking a couple of big traders. This is case in point what we try to do here in Delta Strike. All right. Thank you. We are, so yesterday, a trader bought the 21-19 put spread, 9,000 of them. To make matters better, we see a little May 2nd, 18.5 put bought. This guy's real happy. So the volume that we saw was our big tip off, like, hey, gap is up big. All right. And the big trades that we're seeing are to reverse this. So think about this. Gap had its bet yesterday. All right, Wednesday. When we bought this put, Gap was having its best day in terms of a candle. Its best day in the last year was the 7th. But its best kind of bull candle day, bullish engulfing, exploding higher through the 50. Best kind of real strong day outside of a couple of gaps. And big money is saying, I want to buy puts on this. That was our big tip off. So what do we do next? We go to our option chain. Because what's our big edge here in Delta Strike? All right. One, I can spot order flow and figure out what big money is trying to do. But our bigger edge, what gives us an advantage over the banks that are doing these trades, is we are options experts. These guys know the stock. They don't know the options quite as well. So they're more interested in getting the trade done at a price. They don't as much care about whether it's the best trade. Right? When I'm about to buy 10,000 puts, I know I'm not going to get the best price. So because we're smaller, right? Because we're not, we're all small, we're individual traders, right? There were 300 people in this room yesterday. I put out an order for 5 gap puts. If every single trader in the room bought those 5, that would have been 1,500 contracts. How does that compare to the 10,000 that this trader bought? It doesn't. So that's why we have the ability to kind of look around and say, okay, where is there a better option trade than what this trader just did? All right. And when that's where our edge was. So we've got our 21 puts. I can see you guys closing it. And, you can see how much implied volatility is up and how the volume is up. We're that volume, guys. But what's fun is, May has something called Vega that April doesn't. All right. So what does that mean? Vega is how an options price changes when this number. Remember, I was talking about the cost of options, and I showed you that number underneath the S&P 500. Here. Remember, I showed you this yesterday? All right. Well, this cost of options number, all right, in April, it's up 16. In May, it's up 11. So you're saying to me, Mark, April the cost of options in April is up way more than the cost of options in May. Why didn't you buy April? Maybe you'd ask something like that. The answer is that's not the entire story of an option. Options have this thing called Vega, exposure to changes in option pricing. April's exposure, that Vega, is 1. What do you think May's exposure is to changes in option pricing? Do you think it's more or less than April? It's more. Yeah. This number is 2. So, would you rather have 16 one time or 11 2 times? What would you rather have? Yeah, 11 2 times. This is where we pull the rug over big money. They get this, and they get the price movement, how the stock is going to move. But what they don't get is this number. And this is where we get them. Here is the 16. Someone was asking, Mark, where is that 16 figure on this options chain? Here, I'm going to cut this so you can see it. Where's panel? Here we go. All right, I'm going to show you exactly what it looks like. I'm going to put it right underneath. There we go. All right. So, look. April. There's yesterday's April number when we did the trade. Here's today. Here's yesterday. Here's today. So, basically, if we had done April, we would have picked up about 19 points. And May, we picked up 13. 19 times 1, 19. 13 times 2, 26. That was why not only did our trade do great, but did even better because we picked the right option. In at 72, for me, out of $3.10. So I just want to quickly tell you our process here when I close a trade. I send out the order. And this is for every service here at Option Pit. I send out the order. Once I click publish, once my trade order is sent, okay, which to you guys, it's emailed, it's pushed. You know, we have the ability to send it directly to your phone. The countdown starts. I have to wait a full 5 minutes before I trade for myself. And that's what I did. And so I sold my put at $3.10. That's going to be good for a 343% win. Not so terrible. And now the question is, can we do it again? CEB says, where does that 2x come from? It's from a number called Vega, which is an options measure of exposure to that change in option prices. All right, now, I know a lot of people are excited. It is our 15th anniversary. We've got people basically saying, hey, how can I join you next week, Mark? I'm going to enjoy today and I'm going to enjoy tomorrow. But, after the gap trade, after kind of listening to you talk and teach for an hour on Wednesday, trying to teach you guys stuff, how this stuff works, following after my first experience with CRT, consistently profitable, repeatable, and teachable, and my first trade making me 300+%, I'd like to get into Delta Strike because I want to join you next week. Good news. I've got a 15th anniversary present for you guys. So 15 years. So after 15 years, I'm offering you 2 years of Delta Strike for just $1,500. It's less than $100 a month. It's an absolute steal. And we would love to have you on board. All right. So if you want to join, you can call my team, 888-872-3301, or you see the green bar above me, you can just click that. So there you have it. And now let's dig in to what we're going to do today. All right. So today we're going to we've recapped what just happened. Now I want to kind of talk about how does this volatility event compare to what we've seen over the last year, 2 years? And where do I think we're going? All right. How is today similar to what we've seen in the past? And how is today different? And do we have periods of time where this has been the pattern that we're seeing today? And we have a very clear pattern developing. And guess what? It's a lot like what I told you yesterday. Remember yesterday I said the market was pricing this market like it was a binary event, a coin flip, where if it lands on heads, we get some real ugliness. And if it lands on tails, we could explode. I would say pretty clearly that's how things have played out today. So let's take a look at what happened today, and let's see how this compares to other events we've had in the last few years. and let's learn. So let's start with what we're looking at. So do you remember what I told you the VIX is? The CBOE volatility index. This is our overall measure of option pricing. How expensive is it to buy or sell an option? This is what the VIX is. When option prices are high, markets are freaked out. When they're cheap, markets happy. Now let's start with the option prices right now. We're at 54.75. We have taken out the lows that we saw in mid-March. At the absolute peak of fears today, what do you notice? We couldn't even take out the March high. Currently, again, if we closed here, we'd be closing at a well below anywhere we've been since, last September. VIX is 2660. Biggest move we've seen all in over a year. Biggest move since August, and we can't get a VIX of 30. So what is actually happening? And you know what is actually happening? Do you want to know why I concentrate on order flow? On big money flow. One, the options marketplace is now bigger than the stock market. By a long shot. So what causes us to have the VIX not be able to top out? Right? Mechanically, when the market drops, option prices should go up. Mechanically. Let me explain it to you this way. If the S&P is moving $10 a day, and I'm going to make this super simple. All right. So let's say the S&P 500 is $100 and it's moving $2 a day. Right? That's 2% movement a day. Pretty fair? Right? 2 is 2% of 100. So if the S&P is moving $2 a day, it's moving 2% a day. Now let's say we get a big sell-off and the S&P is now $50. If it's moving $2 a day, it's now moving 4% a day. That's more volatility, more movement. So there's that mechanical piece. That's why VIX is actually still up today. But what we're seeing, all right, and this is a big word, but it's important. When we get a volatility event, are people hedging or monetizing? When we get a volatility event, are we hedging or are we monetizing? So if we get a volatility event and we're hedging, that means we think there's follow through. We're terrified. Buy me as many puts as you can. And then what happens when everybody's just chasing for puts? They're going, gimme, 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 gimme. I need puts. That's when option prices explode and the VIX is 35, 40, 50. When we monetize, we're down 200 points and VIX isn't breaking new highs. That means we were already hedged. We already had positions that made money if the market dropped. And now we're taking money off the table. So our gap trade, we were monetizing. We took our dollars. And that's what we're seeing in the S&P 500 today. So now let's get back to VIX. All right. So I want to start kind of going back through what we've seen. Now, typically, the way I thought things were lining up in March was to form something like August. This is called a volatility swell. Everyone write this down. Volatility swell. A volatility swell, all right, is when you see the VIX come from a low, and then over the course of several days, 10 days, 12 days, with the S&P not really doing a lot, we see the VIX catch a bid. Just a little, it's up a little to a medium amount every day. And the next thing you know, VIX has moved from 12 on July 12th to 19 on August 1st. And then you get kind of your first kind of mini VIX. You get kind of a mini VIX pop. You get option prices, you're over 20 now, and then you get your blowout, right? It's the classic, we kind of break, option prices break out on a Thursday. They go up more on a Friday. And then we crash out on a Monday. We get that big event. And then we get some selling, get kind of a mini fall through, and then we're done. Next, December. This is not a swell. This is a spike. You know, we're kind of trading in range. You know, we've been hanging around about 15. You know, we get a little bit of a VIX rally, nothing crazy. And then out of nowhere, boom. And then as quickly as it goes up, it comes right back down. So now we've got what we're looking at here. And you get the swell. We got the volatility swell, but it didn't end in a spike. All right. Right. So a spike is VIX option prices are low, explode higher, and then come right back down. Swell. You get kind of a wave of option buying, and then it comes into ends in a cataclysmic event that lasts several days or several weeks. So we got this swell, but we never really got the crazy spike. We pull back down, rally back up, hit a new low, but VIX doesn't top out. So I was looking for kind of examples where we've seen something like this. All right. And it wasn't, the debt downgrade. It wasn't all the silliness in 2014. It wasn't the Chinese debt issue. You know what it kind of looked like? Was like some of what we would see during really low volatility periods. You get this kind of rise in VIX, and then it just kind of pulls back. And we get kind of a little secondary spike, and it pulls right back. It's weird, but we're getting kind of low vol VIX movement when it's in its 20s. We're getting the kind of the movement option prices make when VIX is 14. You can make an argument. It kind of looks, what we just saw kind of looks like a little longer dated from like, that August 2019 period. Again, low vol environment, right? Look, we get kind of this move higher, pull back, get one more push, and we're done. And then here's COVID. Looks nothing like COVID. So yeah, we're in a unique spot. And do you want to know why I think we're getting low vol action in a high volatility environment? Why do you think we're getting low VIX action when the VIX is in the 20s? If you had to take a guess. Rodney says zero DTE products. Florida Woody says algo suppression. ICAC says confidence. I think Grant just hit the nail on the head. Afraid to miss out. Afraid to miss out. Well, it's not that markets want to retire. It's that people like you and me and Hannah and Christian are more afraid of missing out on the rip than they are of the market taking a dip. I mean, Listen, I may look like a young a spring chicken, but I'm 46 years old. I've been in this business for 24 years. I've never seen it before in my life. I'm told the closest thing to this kind of action was .com stuff. That's where we are. All right. So now, what does this mean for us? And what are we going to do about it? All right. One, our thesis that we're probably through this tomorrow at the latest remains intact. Monday morning would maybe be the latest. So we're now in a really interesting position to kind of play both ways because there are still big winners and big losers here. Some that are playing out already and some that are not. Like, is Goldman Sachs a loser? Did Goldman Sachs close the gap? It doubled closed. Well, we're going to let traders tell us. But here's what I'll tell you. If I see good, big money flow on a bull trade, I'm really not that afraid. Same thing on puts. There will be divergences here in this market. And again, this is not really, the pain is all in Mag 7, notably Apple. Apple getting absolutely face punched. This is Apple. This is Amazon. This is Microsoft. They're a huge portion of this pain. Apple's down 8%. It's 7% of the S&P 500. Apple alone is over 0.5% of the S&P sell-off. So, just kind of keeping an eye for traders that are normal Delta Strike people. We've got kind of two trades that are in play that we're keeping a tight eye on: XPEV and AM. XPEV, might be a close today, even though it's just up a small amount. And AM is just a hold. So I know people are going to want those updates. Now that we've got that out of the way, let's see. Let's see where we can go next. Kind of the levels I'm watching. And the main level on the downside in terms of whether we were going to fully break lower, we got within a very close stone's throw. We were watching 54.04. We got down to 54.20. If we broke that, then we would be talking about, and that was the low from September. But if we got that, then we would be starting to talk about, August lows, 51, 5,200 areas. But again, with monetization happening, I don't see a lot of, I don't see that happening. All right. So now let's see if there's something out there that can make us some money. Let me get our scanner going. Now, what you're looking for is to make sure that you're not seeing any silliness. But, I'm going to point out a VIX trade that went up for size, and it's going to kind of prove my point. All right. I want you to look at this trade that went up at 11:16 Eastern time. You have a sell of 51,422 of the April 20 calls. They collected 490. Above that, you've got a buy of the same amount, and they paid $1.49. So this is either one of two things. One, the trader owned the 20 calls, sold them, and then it wanted to play volatility continue to go up and bought the 30 calls and then put money in his or her pocket. That's called a close and roll. The second is that they were closing a vertical spread. So that would mean sometime back, they bought the April 20 calls and sold the April 30 calls in what's called a call spread or a call vertical. And today, they are selling that call vertical. And the final, I guess the third option would be they're opening a short call vertical. Meaning they're selling to open the 20 calls, buying to open the 30 calls. Well, when we look at April VIX, sorry, wanted this one. All right, on the 20 calls, 255,000. Remember, I told you these different columns. This first one is how many people own this option strike. The next column is how much of this option strike has traded today. Then you get its exposure to stock movement, how much the option costs, and then the actual dollar cost. So here's my cost of option calculation, and here's the actual dollar cost of the option. All right, well, we've got 255,000 open, meaning 255,000 people hold these 20 calls. 80,000 have traded today. 187,000 people own the 30 calls. 88,000 are trading today. They're selling to close. They're selling to close. And the interesting piece is they're not buying anything. They're just taking the dollars. All right, let's see what else. This is like a bond fund. That's not something we want to play with. All right. In my watch list yesterday, normally right now I would be sharing with you guys my watch list. Which is also not posted. But normally I would be looking over my watch list, but I think I basically laid out the entire watch list just now. Ah, there you go. Thank you. All right. Yeah, but I broke down AVGO. And we were looking at AVGO yesterday, and the trade that we looked at was kind of a cool complex trade. But by the way, this is maybe the best AI image I've ever come up with. And then I write, "Did you like my tariffs?" And then the swan says, "Oh yes, Mr. Trump." But this is kind of something that you're going to get every day. Once a week, I do a full trade breakdown of just one trade. The rest of the time, I send you kind of the 4, 5, 6 most interesting trades I looked at. But, I broke down that this was kind of what the AVGO trade that I was referencing looked like, and then talked about how it was similar or different to a traditional butterfly. And then I kind of laid out how that trade works. Trump just set new tariffs for importing into Microsoft Excel. Oh, that's incredible. All right. So I just want to kind of explain that. All right. But I do want to go back and look at AVGO, but I like to, the first thing I like to do is kind of go through all the kind of the order flow that I'm interested in, and then we kind of look through them. So I stopped at that VIX trade because I was trying to explain. It was a really good example of monetization. And today, you've got Sunrun June 7 calls, but there's something there with those June 7s that maybe they're not as good as we think. So I'm looking for kind of some fun individual trades. HPE trading $14. This is likely a put sale tied to stock. That's not going to be up our alley. So this condition, if you guys can see where it says condition, this tells me kind of what kind of trade was it. So multi-leg auction means it was like that VIX 20-30 call spread. There was more than one option in the trade. Stock opt cross means the trade actually was done in conjunction with a stock trade. And then single leg non-ISO or sweep or auto execution, those mean single leg floor. Those all mean it was an individual option, just kind of executed in different ways. All right. And if you're new, when you're in Delta Strike, we learn. All right. This isn't supposed to come overnight to you guys. Some of the stuff that I'm trading with you on and talking about. But I want to just remind you, like, my first year of option trading exposure was literally me just training. I didn't make a single option trade until I'd been working for the market making firm that hired me for close to 12 months. So don't get discouraged, people. All right, now I know what's going on with the HPE trade. All right, here's a bull trade. Remember I was mentioning that we saw some out-of-the-money call buying in DraftKings yesterday? We've got more of it today. About trader buying 11,243 of the August 52.5 calls for 42 cents. Underlying is $32. That is pretty aspirational, to say the least. And I'm going to explain the HPE trade in a second, MM. So right now what I'm doing is just kind of gathering the trades that we think are good. And right now we've got HPE. We've got, I'm going to look at the DraftKings trade, but probably not do anything on that. All right, here's another fun one. Carnival Cruise Lines. Trading 1773. I have an outright buyer of 10,000 June 20 calls. That is bullish. You know, Rome was not built in a day. Just remember that, folks. All right, we're continuing to kind of walk through. Here is another kind of interesting trade. FL. This is Fleur. Oh, no, it's Foot Locker. All right. So where are some areas where we could maybe see some more downside? Well, I don't know. We're going to take a look. But somebody bought 10,000 January 2027. So these have about 3 years. And they paid $1.85. Folks, remember how we were talking about U.S. Steel yesterday? And I kind of dug into that U.S. Steel trade. Well, we've got more of those May calls being purchased. I'm looking and I'm seeing 20,000 May 45 calls, meaning they want it to go above $45 a share, and they paid $2.45 and $2.44. All right, here's a fun one. AGNC. And all right, so we've got CCL, FL, AVGO, Foot Locker, maybe not. All right, AVGO, CCL, DraftKings. So I'm going to pull two more. Well, AGNC. Let's see if we can find one more really fun one. Nike. We got a long-term bull trade in Nike. All right. So let's start with DraftKings. Yeah. So Nike is going to be hammered by tariffs. Let's start with these DraftKings calls. All right. So this is why when you see, and you know, Carol, what was it? Carrie was, asking, hey, can I get a little deeper into, how I know it's a close? All right. So generally speaking, we can figure these things out pretty easily. All right. And the answer is that open interest number. So think about it this way. If let's say a stock is trading $10, and on that $10 call, there is 100 open interest. So it means 100 people own those $10 calls. Or, one person owns 100 potentially. So now the next day, that stock is up $2. And we see volume of 100 with the open interest at 100. What would you surmise is happening? Are they buying more calls, or are the people that already own those calls taking their money? Right. So these 52.5 calls, open interest is 41,000. 22,000 have traded today. And this will be, so we see a huge amount of these calls going up on March 20th. This is some of the fun stuff. We go back and look at trades. And what do you know? A trader sold 26,000 of these at 107 versus some June 50 trade. And we've got, some more of these call sales going up. So all of the volume on that strike took place on March 20th, and it was all sales. And now today, we see people buying 22,000 of them. So what do you think they're doing? What do you think big money is doing here in that buy? What word did I use at the top of the show, guys? Hedging, or starts with an M, people. Throw it out there in caps. Yes, monetizing. Yes. Monetizing. All right. So that's a not one we would track, right? We're looking for kind of new trades to be on board with, not old trades. All right. So now CCL, June 20 calls. Open interest, 10,197. And We've got 10,000 of those June 20 calls trading, buying. All right, well, let's see what's going on here. Oh, interesting. So the open interest that we currently have is not related to the trade that is going up today in Carnival Cruise Lines. All right, so what I want to do is start in February. So in February, open interest was 8,735, and it's grown, over the past over those few weeks. But we don't have any big 10,000 lot orders. We just have a few hundred a day trading to get us to that 10,000. And then today we have a flat 10,000. So what I'm here to tell you is Carnival Cruise Lines is down $2.30. And this trader is taking the other side of that trade. All right, AVGO. Glad we didn't go in on that trade, folks. Buying or selling volume, yeah. Because sometimes the open interest can be from the selling side, like people selling puts. But yes, if you see open interest increasing, that means that was new volume. Does that make sense? Today in AVGO, we have a buyer of the June. The biggest trades we see is that seem to have some bearing. We've got the May 16th 155 puts trading for $9 tied to stock. So that's more of a movement play than a directional play. We have a strangle seller. Or they sold the August in the money put, and then somebody sold the June 235 call. And then we see a buyer of the June 190 call for 560. And a buyer of the so the 200 210 call spread going up. So we don't really have any follow-up bull volume in AVGO. All right, AGNC. So right now, the only one I'm interested in is CCL. Now, AGNC, this is a REIT. Down 13 cents today. We have a buyer of 10,000 of the September 9 put. They paid 62 cents. And again, we have to go look at September. All right, and now this is one where I'm looking to see, is there we got 15,000 going up today. And this is another one where there's been a slow build. So right now, with how AGNC is trading, I'm thinking that this is additive. That they're adding to this open interest, but I kind of need to wait till tomorrow, and then we would come back and look at this one. Then, last but not least, what's up with May 23rd? Oh, there's just super wide markets. It's nothing. And then we got NKE down 12 bucks, getting absolutely hammered, murdered. And let's see what they're doing. Like, it's super busy. And what is the volume we're looking at? June 60, 75, Jan 2026. So 9 months from now, trader bought 8,000 60, 75 call spreads. Next trade up. This is a July collar trade. So that is actually someone hedging around a stock position. We have a sale of 4,000 of the 60 puts, December 2027. And then we've got some action in the very recent with a couple of minutes apart, 3,000 of the 60 calls bought in succession. Got some 62.5s going up too. So those are really what we're looking at. I kind of like Nike. You can see, look at this. 12,000 of the 60 calls for tomorrow have traded today. You have the 60 calls for next week. 11,300 of the 60 calls for regular April. And then you have the 60-75 call spread. Now, I don't love how expensive these options are. But at the same time, they're actually not that expensive. What do I mean by that? Well, volatility's way up. But remember at the very top when I said, the S&P is $100 and we're moving $2 a day. It goes to $50 and we're moving $2 a day. Volatility has to go up. This is going to bring it back full circle. Nike's down 12%. What do you think is happening to the options of Nike today? See my point? Yeah. So this is a lot from the fact that we dropped and it's still moving at about the same rate. So what I'd like to do is this is almost like a reversal of the gap trade, right? Gap's down 18%. My goodness. And you can see our trader took his money, and then it looks like he bought some of the 18 puts as well. Yep. We made a lot more money than this trader in Gap. He paid 45 cents for his put spread, and then he sold it at $1.54. I mean, good, but ours was better. Wait a minute. So you're not getting that love there. Nike, and this is the one thing that worries me about jumping in on Nike, is just it's not like things were good before. CCL, I mean, pretty similar story. Although their earnings weren't that bad. Take a look. Here's their earnings. Actually went up. And it's just kind of taken on the chin. But it's down $2.26. So that means yesterday it was trading $20. Are we in agreement with that? So yesterday it was $20. And today you can buy the $20 call for May, which has 6 weeks for 60 cents. How much do you think this call cost yesterday when the stock was 20? All right. So with this call was $1.35 yesterday. $1.35 yesterday. Currently 65, currently 59 cents. The June 20 calls, they were $1.90 yesterday, and today they're 90 cents. So, I did 5 we did 5 of those gap puts yesterday. And on my puts, so this is just for me. All right. I made $1,190, right? On my puts. I can go out, fade this move, buying 3 of the May calls, and still have $1,000 of cash in my pocket. All right. Yeah, if you did $1,000 per trade, there we go. You'd have done 13 or 14 contracts. So you'd have made $3,094. Yes. I probably would. All right. So what I want to do, I'm really tempted on these May 20 calls, and I'm really tempted on the Nike calls too. At the same time, we're down $215. And mornings have not been the same at night. So here's our story. I need you guys to be paying attention. Stay tuned. Make sure you're opening the mail we're sending to you. Because I'll know whether I want to go into CCL or Nike probably closer to 2:30 Eastern time, 2:30, 2:45, 3 o'clock Eastern time, once the afternoon session has kind of played itself out. All right. I'd rather know for certain I want to go long than to just sit in front of you because you're here for free and we're showing you what we've got here, then try just to put on a trade for you guys just because, right? Gap I didn't put on to impress you people. I put on because I thought it was going to be a really good winner. All right. Now, do I think these could be really good winners? Yes. Am I confident like I was in Gap yesterday? I'm about 85% of the way there. So this afternoon, if I get to that 100, we'll post this in the announcements. It'll be emailed. It'll be emailed out to everybody who's a member. And we'll go from there. But you have to make sure that you are paying attention to your email. And yet again, if you'd like to join Delta Strike, we're offering for our 15th anniversary 2 years for $1,500. That's way more than 50% off. And we'd love to have you join us. So we've been at this for an hour and 15 minutes. I think you guys have been listening to me chat. But if you'd like to give us a call, if you've got questions, the number is 888-872-3301. My guys, Drew and Zach, will take extra good care of you. And yet again, thank you guys. Happy anniversary. And thank you to everybody that got us here. All right, everybody. I'll talk to you later. So for Hannah J, Christian P, and Justin B, and Chip and Vicky, and everybody involved. I'm Mark Sebastian. I'm your only option. And I hope you guys have a great day. I'll see you tomorrow.